solar panels and microchips, et cetera, using more silver in a given year than the world's mines are producing. So there's a deficit. The above ground stocks of silver will have disappeared. And then the only thing that's left is pricing to bring the deficit back into balance. The price of silver is going to have to go way up. And that's where you get the possibility for a default on an exchange. And if that happens with silver, it's just such a tiny market. You could get like a Bitcoin level price move where silver goes from $35 an ounce to $70 an ounce in a heartbeat, just because there's no more left. And the COMEX has defaulted, And I think that's one of the really interesting prospects out there in precious metals.
The global silver market is facing a precarious situation, with the potential depletion of above-ground silver stocks looming within a few years. JohnRubino, from rubino.substack.com, highlights the concerning deficit in silver supply versus demand. According to the Silver Institute, from 2021 to 2023, the market experienced a cumulative deficit of 474 million ounces, equivalent to 14,743 tons. This persistent imbalance underscores the vulnerability of the silver market to supply shortages, potentially driving prices significantly higher. Rubino emphasizes the unique susceptibility of the silver market to price fluctuations due to its relatively small size. With demand consistently outpacing new supply, the narrative of a silver shortage is gaining traction. Such a scenario could prompt rapid increases in silver prices, potentially surpassing its previous all-time high, near $50 sooner than anticipated by most analysts. The situation in the gold market also adds to these concerns. Central banks' increased gold purchases and sustained demand from other buyers reflect continued confidence in gold as a store of value and a hedge against economic uncertainties. According to the World Gold Council's Gold Demand Trends Report, global gold demand rose 3% year-on-year to 1,238 tons in the first quarter of 2024, marking the strongest first quarter since 2016. However, Rubino warns that this heightened demand for gold, coupled with potential shortages in the market, could lead to challenges in metal exchanges. The possibility of contract defaults and increased market volatility looms large, raising questions about the stability of precious metal markets in the face of growing demand and supply constraints. Join us as we delve into JohnRubino's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
And it's interesting which central banks too, because it's not the U.S. buying gold, and it's not it's not Western Europe. It's Eastern Europe, China, Russia, and India, and Turkey, and then a few other countries. But they're buying the hell out of gold, really, because those central banks alone, not counting the individual citizens of those countries who are also buying gold really aggressively, but just the central banks bought 1,000 tons of gold in each of the last 2 years, which is a huge offtake in a market where the world's mines only produce like 4,000 tons. So it's it's 25% of the market being snarfed up by basically new buyers. And that's part of why gold has gone from $1,700 or $1,800 an ounce a couple of years ago up to 23-ish right now, and that's a nice move, but it's nothing compared to what happens if these trends continue, because it's not clear where the extra gold comes from if China and Russia and India keep on buying it, and then everybody else who normally buys gold keeps on buying too. So we could have a shortage of available metal, which causes some of the metal exchanges to stiff their futures contract customers. In other words, saying, well, yeah, you got a futures contract that's worth this much gold, but we're just going to give you cash instead,
Yeah.
And
Well, they're allowed to do that.
They're allowed to do that, but it still constitutes a de facto default. And everybody will see it as a default. They'll say, oh, COMEX didn't have enough gold to pay off this month's contracts. Well, I want to be long the commodity where that's happening on the metals exchange, and then people will just buy the hell out of it at that point, even more so than they are now. And I think silver is a bigger candidate for that, really, because it's such a tiny market, and it's already in a fairly extreme deficit industrially. In other words, solar panels and microchips, et cetera, are using more silver in a given year than the world's mines are producing. So there's a deficit. At least one analyst is out there saying, okay, we can cover that deficit for now, but within 2 years, we won't be able to anymore. The above ground stocks of silver will have disappeared. And then the only thing that's left is pricing to bring the deficit back into balance. So the price of silver is going to have to go way up, and that's where you get the possibility for a default on an exchange. And if that happens with silver, it's just such a tiny market. You could get like a Bitcoin level price move where silver goes from $35 an ounce to $70 an ounce in a heartbeat, just because there's no more left. And the COMEX has defaulted, And I think that's one of the really interesting prospects out there in precious metals. The kind of world where precious metals are doing that, where they have that kind of a trajectory, is a stressful world. But I think we kind of guaranteed a stressful world in any event. So we might as well make a lot of money from our silver longs while we're waiting for the world to end. We die rich when the missiles start flying.
I guess that's what counts in the end, right?
Well, we at least I have missed the other saying of live fast, die young, and leave a good looking corpse. But maybe we still have a chance at the guy who dies with the best toys wins. That's
right.
possible.
According to Atlanta Federal Reserve President Raphael Bostic, the U.S. central bank is likely to proceed with interest rate cuts this year, despite uncertainty regarding the timing and extent of the policy adjustments. Bostic expressed confidence in the potential for rate reductions, emphasizing the need for monetary policy flexibility, even as inflation remains subdued. Financial analyst Rubino highlights the sensitivity of the current financial system to interest rates, cautioning against the ramifications of higher rates given decades of increasing borrowing. He warns that elevated interest rates could trigger widespread financial instability, particularly evident in the sharp rise in mortgage and car loan rates. Meanwhile, recent data showing a decline in U.S. consumer sentiment to a 6-month low in May underscores concerns about rising living costs and unemployment. Economists urge careful interpretation of these figures regarding their implications for the overall economic outlook. Rubino further emphasizes the risks associated with large-scale bailouts and monetary stimulus measures, warning that while they temporarily alleviate financial turmoil, they could exacerbate inflationary pressures and widen wealth disparities. This, in turn, could fuel social unrest and political instability, posing significant challenges for economic policymakers. Let's get back to the interview.
So many things pointing in the direction of, a crack-up boom or something like that, where the people just lose faith in the currency. So yeah, we could go on all day just about those signs that are out there. But one of the big ones, I think, is the Fed saying, okay, inflation is 3 to 6%, depending on what measure we're using. And our next move is not going to be a rate increase. We promise you that, so we're going to hold rates steady, or we're going to cut them, but that's it. And, with, let's take the high end of the range. And if inflation is 6%, that's a massive crisis. That destroys the savings of a whole generation in a very short time. And no Fed worth the name of central bank would ever let something like that happen without tightening to bring inflation back down, ideally to zero, but at least to their made up 2% target. But apparently they're not doing that. And the reason for that is that the system can't handle higher interest rates. So what are they going to do? You can't tighten monetary policy after you've already spent going on 50 years now, borrowing more and more money each year to the point where everybody is interest rate sensitive. So you raise interest, or even if you just keep interest rates the same as they are right now for very much longer, stuff starts blowing up. Mortgages, 7% and change right now, car loans, 10% plus. I think the commercial real estate thing, as you and I have talked about, is probably one of the big victims of that, which means the local and regional banks are one of the big victims of this whole thing. So that could be where it happens first, but any number of other catalysts are out there waiting to blow things up. I think bank failures are part of the next 6 months for sure, just because, well, here's the mechanism. Commercial real estate, all those buildings that went up, especially office buildings over the past decade, were financed with relatively cheap money, and they had lots of people working in them. But now money is not cheap anymore. So those buildings have to be refinanced at higher interest rates. And after the pandemic, when people found out that it's nicer to work from home than it is to commute into a city to
Yeah.
work in a cubicle in a high rise, most office buildings have lower occupancy than they did. They're getting hit with a double whammy. Their occupancy is down, which means their cash flow is lower, and the interest rates at which they have to refinance are much higher. So a lot of these buildings just aren't worth doing that. And so they're changing hands at big discounts. So a $200 million building is being sold for 110 million. In some cases, they're being sold for like 2 million. And those losses have to be taken somewhere, right? And they're on the balance sheets of local and regional banks. So let your local bank report a big loss on its commercial real estate. You're going to pull your deposit out, you and all the other depositors. That will cause a bank run, which breaks the bank. And then that fear will spread to all the other local and regional banks, and you'll have a run on a sector. And the government will have to step in with several $trillion this time around of bailout money, which makes it look an awful lot like the pandemic, right? They're going to have to do something that's on a scale of the stimmy checks. And that led to a increase in the money supply of between 40 and 60%, depending on which measure that you use, which in turn led to an inflation rate officially of 8.75% in 2022, but was really something like 15%, put a huge part of the country in very dire financial straits because they can't cover their inflating day-to-day expenses. So if we do that again, I think it'll just tear a hole in the social fabric, and we'll be pre-World War II Europe or something like that, where there's just battles in the street because everybody's savings have been wiped out, and there are all these ideologies explaining it and offering to take over in place of the existing government. That would happen. So it's not clear how the government gets out of making that happen by bailing out all these banks, because they're probably going to need that bailout.
Silver is edging closer to breaking through a formidable barrier at $30 after finding solid support around $26 during Fed Week. Traders are now focusing on silver with growing anticipation that it could be the next to reach new all-time highs. Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.